Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Well, welcome back, and thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with education to maximize your investing success. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the weekly program on real estate investing. If you can't make the live show, you can catch your podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can go to TomWilsonProperties.com for a lot of education information on investing in general, the economics of real estate, how to buy good rental houses, and how to invest in commercial and multifamily syndications for as little as $50,000 a share. We also, of course, welcome your input for recommendations for guests and topics, and always pleased to answer your questions. We're very pleased today to have Tom Wheelwright, the Rich Dad tax advisor. Tom Wheelwright is a leading tax and wealth expert, best-selling author of many books, including Tax-Free Wealth. He's a CPA and CEO of Provision Wealth. Tom's best known for making taxes fun, easy, and understandable, and specializes in helping entrepreneurs and investors build wealth through practical and strategic ways that permanently reduce their taxes. As a Rich Dad advisor to Robert Kiyosaki, Tom frequently speaks at Rich Dad conferences worldwide. His work has been featured in Forbes, Counting Today, ABC News Radio, the Real Estate Guys Radio, Money Radio, and as of today, Real Estate Radio Power Investing. Tom, welcome to the program.
Hey, thanks, Tom. It's good to be on.
Nice to have you here. You know, making taxes fun, easy, and understandable kind of reminds me of the old hook lines that U-Haul used to have, adventure and moving.
There you go.
But they gave up on that one. But I think it would be a stretch for some people to think of it as fun. But by golly, I've heard you speak a number of times, and I got to admit, you have as riveting a presentation as anybody on taxes I've ever seen.
Well, I appreciate it. And actually, I can actually prove it's fun, and this is the perfect time of year to do that. If you think about what's the best part of the tax year is the day you get your refund check, right? If you look at that word refund, fun is right in the middle of it. So I think nothing is more fun for most people than that tax refund that they get.
And just saving money in general. Before we dive into some tax specifics, I know you just were at Robert Kiyosaki's 20th anniversary of Rich Dad, Poor Dad, and I had the good fortune about 10 days ago to also be on board the ship with the Summit at Sea, where we also celebrate his 20th anniversary. Any takeaway thoughts on that special moment and celebration?
Well, yeah, I'll tell you that Robert is more gung-ho than ever. So he actually is at the celebration. He was talking about the new programs that he's launching and the new work he's doing, and he's got an amazing amount of energy. And here's a guy that could sit back and relax and enjoy his wealth, and instead he's out there laying it on the line all the time and speaking and promoting. And I have great respect for anybody who is as mission driven as Robert is.
Isn't that the truth? And he and I are only about 4 months apart in our age, and we enjoy swapping notes when I get to see him on how exciting it is to still be active and engaged in the world. And I know he certainly, as much as ever, just loves teaching and teaching people about finance. I know you do as well.
Absolutely. Robert and I last year traveled 12 different countries all over the world, and we'll be traveling again this year. And it's a message that needs to be said, because so many people are stuck. They're really stuck in this idea of go to school, get a job, invest in a diversified fund of portfolio of mutual funds and do a 401k or an IRA. And there's an alternative, and there's another way. And I know that's what you talk about, Tom, but there are alternatives to what everybody else does, and there are alternatives that actually can be much more successful with the proper education.
I remember the first time I heard you, Tom, was probably 6 years ago. And although I'd, was certainly knew who you were and had read one of your books, but I remember you saying in your presentation something that just really struck me, and I've shared that with many other people, and that is that everybody's so afraid of the tax code. And I recall you saying that there's only like 15 pages that tell what you have to pay, and 8,000 pages that tell how you can avoid taxes.
Well, that's exactly right. You actually have only two lines. You have one line that says all income's taxable unless we say it isn't. Another line that says no expenses are deductible unless we say they are. And there's a couple of pages of charts and tables to tell you how much to pay. But most of the tax law, which is about 6,000 pages, is devoted to teaching you how to reduce your taxes. I mean, the tax law is nothing more or less than a series of incentives, primarily for business owners and investors, but there are all sorts of incentives. I mean, you send your child to college, you get a tax credit. You adopt a baby, you get a tax credit. You give money to charity, you get a tax deduction. I mean, those are incentives that everybody's familiar with. What we talk about, Tom, you and I, is the tax incentives that people aren't as familiar with when it comes to real estate and business and other tax incentives for investors that very few people take advantage of. And all we have to do really is recognize that if we do what the government wants us to do, they are likely to give us a tax break for it, and we just have to know what that is.
And I never quite understand why people haven't been better educated about the whole tax code. It seems like the lay person out there thinks that most of the code is loopholes for wealthy people, and what they don't seem to understand is that Congress and has felt that there's certain things that benefit society if they invest in, and they've incentivized them to invest in those areas by allowing them to have tax deductions. So it's not a loophole at all. They're doing exactly what Congress wants them to do.
Right. I think of a loophole as an unintended consequence. Okay, it's unintended. That's what a loophole is. But that's not what the tax law is at all. I mean, the tax law, there are very few loopholes. Most of the tax law is very intentional, like you said, very intentional incentives to do what the government wants you to do. For example, the government would like you to build businesses to have more employment, right? That's one of the big things. That's why Donald Trump was elected, was to gather, more employment in the U.S., all right? And so the government gives tax incentives to business owners who hire employees, who build businesses. The government wants you to build low-income housing, so they give you great tax credits and tax benefits to building low-income housing. They want you to build commercial buildings and commercial centers. They'll give you tax benefits. And actually, that's something, by the way, these are tax benefits that people get all over the world. This isn't unique to the United States. When I traveled...
That's a very good point.
When I travel to other countries, Tom, I always look at the tax law, and I find that the tax laws are substantially the same from country to country. I mean, the tax rates are different, and what they emphasize are different. But the reality is, business, real estate, energy, these are things that every country wants to promote, and they want to promote the public to take their investment dollars and invest in them, and so that they continually give them tax benefits. In fact, I'll tell you an interesting one, Tom. That the U.S. Treasury actually puts out a list every year of what they call tax expenditures, and these are specific credits and benefits that are above and beyond the norm. Okay, in other words, what they think of as the normal tax law. What they don't include in there is normal depreciation, which is the best tax benefit in real estate. They don't include normal business expenses. They don't even include those. They don't even consider that to be an expenditure. That is so normal that's part of our daily life. But most people are employees, and so they don't understand why there are so many benefits to being, a real estate investor, being a business owner that they're just never going to see because they're investing in the stock market instead of investing in the things the government wants them to invest in.
Yeah, that's very interesting that it's most of those fundamentals are the same in most modern countries.
Yeah, they absolutely are, and even it's interesting. Even in countries you don't think of as modern. I mean, we were in we were in Kyrgyzstan, and I've been in South Africa, and we don't necessarily think of some of these places as well. They're not the you don't consider that the same as as if you're in France or in Germany, someplace like that. But the laws are very similar. They still reward investors. They still reward business owners.
Yeah, it just gets back to the fundamentals, doesn't it? What benefits society? If you want to, you don't have to use the tax code, but if you do to incentivize people, then you want it to be for things that benefit everyone, and that includes jobs and for everyone.
Well, what's happened is the governments over the years, and the U.S. is really they started all this, but the governments over the years have realized that people hate paying taxes. I mean, they know that people hate paying taxes, and they know that if they give a small incentive to people to do something from a tax standpoint, they don't have to spend as much money. Okay, if you give somebody a direct benefit, they have to spend more money actually than if they give them a tax benefit, because there's an emotional side to the tax side. So people love a tax refund. They hate paying taxes. And so you give them a little bit of incentive. I mean, think about why most people have an IRA or 401k. The reason they do it is because of the tax law. If they didn't get to defer their income or get some tax benefit out of that, most people would never do it.
They wouldn't save on their own. It's because they get an extra benefit.
That's exactly right. They get a tax benefit. That's why they're actually willing to put their money aside for 30 years or 40 years, and at huge penalty rates to take it out early, just for the idea of getting a tax benefit now, and huge restrictions on what you can use your money for. People are willing to do that because of the tax benefit.
Yeah, and that's imagine how much less we would have if it weren't for that incentive for people to do that and contribute to their own self-sufficiency when they retire.
Well, the reality is the stock market would not be near 20,000, the Dow Jones, if you didn't have 401ks and IRAs, because that's an encouragement to get people to put their money into the stock market, and it would never be there. I remember an interview that on CNN Robert did, and Gene Chasky was talking about how important it was. This was right before the crash of 2007 and 2008. How important it was that people continue to put their money into the system, because that's what keeps the system afloat. That's what builds up. I mean, when you think about it, that's what builds up the bubble, right?
Tom,
you have all this money coming in.
Tom, we got to take a commercial break. We'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're pleased to have Tom Wheelwright with us today, Rich Dad advisor to Robert Kiyosaki and author of Tax-Free Wealth and many other books, and worldwide speaker. So, Tom, I'm sorry I had to cut you off just before the break there. You want to repeat what you were talking about there?
Well, I would if I could remember it, but I'm at that age where I have 20/20 memory. I can remember anything less than 20 seconds ago or more than 20 years ago. But anyway, I mean, it's very simple. The point is that if you want to reduce your taxes, the fastest way to put money in your pocket is to reduce your taxes. It's the easiest way. If you want to reduce your taxes, just figure out, what does the government want me to do? And there's likely a tax benefit to it. And then just do what the government wants you to do. The government wants to be your partner. I mean, for example, if the government wants you to invest in oil wells, which they do in the U.S., the government wants you to invest in oil wells, and they say, look, we'll give you 30% up front. We'll take on 30% of the cost, by giving you a tax benefit, you take on 70% because we're going to take on some of that risk because otherwise we're not comfortable that you would actually invest the money in oil and gas because it's a risky investment. So we're willing to partner with you and take on 30-40% of that risk by giving you a tax benefit for it. Same thing is true with real estate. Same thing is true with business. All you're doing is partnering with the government, and that's really what we're talking about here. Is we're not talking about doing anything that is illegal, nothing that is risky, nothing that's even gray.
Not even an unintended item, like a loophole.
Not even a loophole. Okay. What we're talking about is intentional benefits. Congress wants you to take advantage of these because they want you to do these certain activities.
In the arena of business and real estate investing, can you think of a couple of things that are most common oversights by investors?
I'll tell you, the first one that drives me crazy is home office deduction, right? I mean, if you're a real estate investor, you have a business. You're in the business of investing in real estate. You can have a home office, which a home office gives you all sorts of tax benefits. First of all, you get to write off a portion of your home, your utilities, your maid, your maintenance, all that kind of stuff. But on top of that, okay, what most people don't recognize, and here's a little tip for everybody, is that if you're an entrepreneur, and the very first trip of the day is considered a commute, okay, and that commute is not tax deductible. So that's a car expense that's not tax deductible to commute. However, if your commute is 20 feet from your kitchen to your home office, that's your commute that's not deductible. And what you do after that, when you go see properties, you go see clients, you go see customers, you do that afterwards after going to your home office in the morning, and then at night you come back to your home office. Now you've just increased your automobile expense. So not only do you have an increase, you get a deduction for the home office, but you also get this great tax deduction for your car. Most people will double the amount of deduction they get for their car just by having a home office.
You mean it's acceptable to commute by foot?
It is acceptable to commute by foot. Actually, the IRS came out with a ruling on it. They're very clear on it. Said absolutely, this is absolutely acceptable. You have to do it right. Okay, you have to follow the rules and everything. But what happens is that I hear people all the time. I'll be speaking to an audience of 1,000 entrepreneurs. And I'll ask him, how many of you have ever been told not to take a deduction? And almost all of them will raise their hand. And then I'll ask him, how many of you was it the home office deduction that you were told not to take? And like most of the hands stay up. And the reason they're being told that is they're going, well, it's risky. It's a red flag.
Oh, you mean by their advisor, not by the IRS?
By their advisor. They're being told by their advisor, their tax preparer, their tax advisor, not to take a deduction. Okay, well, here's the thing, Tom. Home office deductions are specifically allowed in the Internal Revenue Code. Second of all, if you set up your business properly, you will never disclose to the IRS that you have a home office deduction. There's nowhere to disclose it. It's only those people who set up, who take the easy way out and they're a sole proprietor and they don't set up properly. They're the only people who have to disclose that they have home office deductions. So to me, if you're being told by an advisor, a tax advisor, to not take a legitimate deduction like the home office deduction, it may be time for you to consider getting a new tax advisor.
That's a good point. And I hear that all the time, that people say, oh, I've heard that it's really risky to go do home office, and but they can never explain why that is. So that's worth listeners listening on all by itself. I've deducted for years and years, only been audited once, and that wasn't even a topic. We have with us today Tom Wheelwright, the tax advisor for Rich Dad, Poor Dad, best-selling author of Tax-Free Wealth and international speaker, and talking about the tax code. Stay with us on KDAW 1220 AM.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Tom Wheelwright with us today, CEO of Provision Wealth and tax advisor to Rich Dad, Robert Kiyosaki. Tom, you just told us about one tip there. Don't be afraid of home office if you do it right. What else can you think of that people often miss?
Oh, I'll tell you another one. This is right up your alley, Tom. Okay, this is what we call a cost segregation. Now, most people who invest in real estate understand that depreciation is your biggest tax benefit, okay? And actually around the world, it's the biggest tax benefit anywhere. What most people don't realize is that how you deduct depreciation is really a choice you make. Most tax preparers, what they'll do is if you buy a piece of real estate, let's say you pay $100,000 for an investment property, they'll say, well, we're going to estimate that 20% of that $20,000 belongs to the land and $80,000 belongs to the building. But the reality is you bought a lot more than land and building. You bought all the contents of the building and you bought all the improvements to the land. And those are depreciated at a much faster rate. But the question is, how do I determine what that is? Because all I have is the purchase price of the building, right? And so what we do is what's called a cost segregation. You have to hire a professional. It needs to be either an accountant or an engineer, preferably a combination of the two. And what they do is they actually go in and they price it out. So they go, okay, of that $100,000 or $1 million building, how much of that belongs to the contents of the building? How much of that belongs to the improvements to the land? And how much of that is the actual building and the actual land? And what happens is that we find that it increases the rate or the speed at which you depreciate by 2 or 3 times to do a cost segregation. It's a huge difference.
Does a code or any rulings indicate guidelines for the length of time for different components?
You know what? They do. I mean, yeah, absolutely. We know exactly how much we're supposed to take for different, whether it's furniture, whether it's it could be the cabinets or it could be the window coverings, could be the carpet, whatever.
Right.
We have there's very precise guidelines for it. What I hear all the time is I'll hear tax advisors who will say, yeah, but that's risky. And I'm going, but there's an IRS audit guide about how to do a cost segregation. So if there's an IRS guide on how to do a cost segregation, why would anybody think it was risky? In fact, if you didn't do a cost segregation, you are technically in violation of the law.
Are you serious?
I'm serious. You are technically in violation of the law if you don't do a cost segregation. Now, the IRS is okay if you don't do one because they get more money, right?
Right.
But the reality is that the law actually specifies that you are supposed to do a cost segregation. So this is another one where people get bad advice about how to this is a risky thing to do, et cetera. Where quite the opposite. It's not just a not risky thing to do. It's actually the preferred way to do it by the IRS.
We've just got about 30 seconds left in this segment. The common retort that I hear from folks is, well, it's just a short-term thing, and when I sell the property, I'm going to have to, recover that back.
Why would you do that? In our next segment, we ought to talk about 1031 exchanges, because you should never have to recover that.
Yep, just keep exchanging it forever and just keep deferring it on out.
Yep.
Okay. So we have Tom Wheelwright with us today, the CEO of Provision Wealth, best-selling author of Tax-Free Wealth and many other books, and a international speaker, tax advisor to Robert Kiyosaki, Rich Dad Group. And we're glad to have him here today talking to us about different tax things that many people don't understand and that are afraid to take. So we'll be back in just a moment here on Real Estate Radio Power Investing, KDOW 1220 AM, the Wall Street Business Network. Stay with us. We'll be right back with Tom Wheelwright.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're delighted to have Tom Wheelwright with us today, as CEO of Provision Wealth and tax advisor to Rich Dad, Poor Dad. Tom, let's talk a moment about 1031 exchange. those of us that are in real estate investing circles think everybody knows about it, but every once in a while I run across someone who tells me they just sold something and now they're going to buy something else with it in real estate, and they know nothing about 1031.
Well, the question here, so 1031 simply is, of course, if you sell a piece of real estate and then the proceeds, without you touching them, are eventually invested in another piece of real estate, you follow the guidelines, you don't have to pay the tax. But here's the key, is that people think, well, yeah, but eventually I want the money. But you don't have to sell the property to get the money, because you can borrow the money from the bank. And you don't pay tax when you borrow. Okay, there's no tax on debt. So you can borrow the money from the bank. You still have access to the cash. I actually was talking to my friend and your friend, Ken McElroy, not too long ago, and they were looking at a deal, and Ken was asking me, he goes, so tell me, look at this deal, and we're thinking about selling it or refinancing it. And we looked at it, and we got more money out by refinancing than selling it, because if we sold it, we'd have to pay this huge tax liability. So, the point is that, first of all, you can get the money out. Second of all, you can exchange into any other kind of real estate. So people go, well, I don't want to, manage properties anymore. Well, okay, so, take the money and invest in a Walgreens, or invest in a parking lot, or invest in something that, that is a triple net lease, like a Walgreens or a Walmart or a big box store, something like that.
Yeah, our syndication business has been doing a lot of these triple nets, single tenant deals. They're really as passive as you can get.
They are as passive as you can get. So it's like a bond, right? It's like buying a bond. So people go, well, I'm going to sell it, I'm going to go buy a bond. Why would you buy a bond at 1% return on your investment when you can buy a Walgreens at 5 or 6%? I mean, I don't understand that, mentality.
And all the tax benefits that come with real estate.
Exactly. And you don't have to sell, and you don't have to pay tax on all that. You've got all this gain that you've accumulated over the years because you've been doing 1031 transactions. Just do one last 1031 transaction into that triple net lease. And then what happens is, and a lot of people don't understand this, when you die, that gain gets washed out. It actually completely goes away and is never taxed. Yep. So we call it defer until you die.
And your kids get stepped up basis, and you've never paid tax on the real estate.
That's right.
And it's wonderful. What direction do you think? What direction do you think we're headed here for tax reform? The Trump's administration is part of what he got elected on was. People thought that maybe things had gotten too complicated and the rates are too high and chasing businesses out of the country and so forth. I guess I'll ask you two things. One, what do you think is going to happen? And two, if you were czar, what would you do?
Well, I think they're going to be similar. Frankly, I think they're going to do what I think should happen. So which is kind of nice. First of all, let me tell you what's not going to happen. It's not going to get less complicated. Okay, so that is not going to happen.
No, Steve Forbes flat tax isn't going to happen, huh?
That's not going to happen. Second of all, we're not going to see personal tax reform. We're not going to see individual tax reform in the next 3 years.
Okay.
This is not going to happen. If you look at what Ronald Reagan did, one of the most popular presidents in history,
yep.
And he couldn't even get tax reform on until his second term. Okay, he won in a landslide in his second election, and then he had everybody. He had a Republican Congress, Republican Senate, everybody wanted it, and they could get tax reform done. So don't plan on any individual tax reform in the next few years. What you will see is corporate tax reform, business tax reform, and what will happen is we will see lower tax rates for businesses, and we'll see some sort of a tax on imports. And we'll probably see what they call an amnesty for bringing money back that's been sent overseas, that's been earned overseas, that's not been taxed, that if a company like Apple or Google brings it back on shore, that they're going to get taxed at a much lower rate.
So we can get that money back into our economic system.
Well, it's not that it's coming back in the economic system, okay? It's just that the tax is going to come back in the economic system. The money's already here. Okay, they've just done it through loans and other types of mechanics. The money's not actually overseas, okay? It's just that they've never paid tax on it. So there is about $200 billion estimated in tax that would be raised by, allowing them to tax it at a lower rate and kind of bring it on shore from a tax standpoint. But I actually think the biggest thing is going to be the import tax, because what will happen is that it'll either be, Trump wants it to be in the form of a tariff, and Paul Ryan wants it to be in the form of some kind of a income tax mechanism.
Okay.
But I think eventually what we'll end up with is a value-added tax, because that's actually the right answer. We're the only developed country without a value-added tax of some sort, and it is killing our export businesses because we don't charge a value-added tax on imports, and other countries do. And so they charge on our exports into their country, and then when they export into our country, they don't pay a value-added tax.
So that would help level the playing field.
Absolutely, and I think Paul Ryan understands that. I think Donald Trump understands that. I think that it may be not right away that it'll happen that way. We'll get some kind of an import tax, but eventually that has to be the answer.
Well, real quick, in about 30 seconds, do you think our real estate investment tax benefits will stand in place? 1031 exchange, depreciation, those things.
Remind me again what business Donald Trump is in?
Yeah,
I'm not too worried about that one. I think we're pretty safe that those incentives aren't going away. At least this term, like I said, that's an individual tax reform, and that's something that, if it happens, would happen in the next in the next Congress, in the next term of Trump's presidency, should he get reelected.
Okay,
and I'm not too worried about that.
You heard it from Tom Wheelwright, and I hope that's how it plays out. And I think that's pretty good authority there. That's a good chance that that's where it's going to be headed. Stay with us here on Real Estate Radio Power Investing. We'll be right back with Tom Wheelwright.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
What a pleasure it's been having you on today, Tom. And you've given us a lot of good tips and foresight. One thing that people have trouble doing is figuring out how to find a good advisor to tell them what to do. How do they go about that?
Well, I appreciate that. That's actually the most common question I get when I travel is how do I find a good tax advisor? And when I wrote Tax-Free Wealth, I put a whole chapter in there. Chapter 23 is how to find a good tax advisor. And by the way, if your listeners, if people go to taxfreewealthadvisor.com, you can actually get a free copy of that chapter. So it will actually walk you through how to find a good tax advisor. But I'll tell you the number one thing. I'm going to give you two things. First of all, any tax advisor who's afraid of the IRS, either afraid of a legitimate deduction or afraid of an audit or anything like that, not the tax advisor you want. Okay, you don't want a tax advisor who thinks that they know less than the IRS, okay? I mean, let me tell you, IRS auditors, these are not VA students, okay? You don't come out of school with a master's degree and you're an A student and decide, I'm going to go work for the IRS, okay? These are more likely your B- and C students in the first place. So if your advisor is afraid of them, then what does that make them, right? So that's number one. Number two is, the question I always get is, what questions should I ask when I'm interviewing? And I actually listed 10 questions in Tax-Free Wealth, Chapter 23. I listed 10 questions you should ask. But more important is what questions your advisor asks you. Because any good advisor is like a good doctor. If you go in with an appointment with a doctor, you say, I've got a problem here, they're going to spend 15 minutes with you. And 14 minutes will be diagnosing your problem. They're going to be asking you questions. Well, any good advisor should do the same thing. So if you have an advisor who's constantly talking about themselves and their qualifications, everything, that's not a good advisor. What they should be asking you is, okay, tell me where it hurts. Okay, what's going on in your life? What is your business? What are your investments? What are you doing here? Because that's how they diagnose. That's how we can diagnose how to reduce your taxes.
Super advice, Tom. How do they reach? How do people reach you? If they first of all, they ought to read your book, Tax-Free Wealth. I have proud to have an autographed version from you that I've read. How do people get hold of you? They want more information.
Best way is go to taxfreewealthadvisor.com. Taxfreewealthadvisor.com is the best way. And you can schedule a consultation if you want. You can get a free chapter of the book. And there's all sorts of information as well on there.
Fantastic. Tom, thank you so much for being on the program today.
Thank you, Tom.
It was a pleasure having Tom Wheelwright. I've had the pleasure of meeting Tom and talking to him a number of times. And he is indeed one of the leaders in the country on tax, the tax code and tax advice. So go to TomWilsonProperties.com and go to our website for a lot of education information. You can look up all of our podcasts from the past and others in the Rich Dad series, like Kenny McElroy and Robert Kiyosaki and Garrett Sutton and many others. And you can also find other information there about investing in real estate. So thanks for tuning in with us, and we look forward to having you back next week on Real Estate Radio Power Investing. Remember, the only thing that matters is what you do next.